What if I told you there's a way to legally avoid paying taxes on up to $10 million when you sell your business? It's called the Section 1202 exclusion, also known as qualified small business stock, and it is one of the most powerful underused strategies in the entire tax code. If you structure things correctly, you could exclude up to $10 million or maybe even more from federal capital gains taxes. And in this video, I'm going to break down how it works, who qualifies, and what steps you need to take so that you can use it effectively. So what is Section 1202? Well, Section 1202 is a part of that mammoth IRS tax code that actually gives business owners and early investors the ability to exclude up to $10 million or 10 times their investment basis in capital gains when they actually sell those shares of that qualified business. Now, this was created to encourage investment in early stage companies, but most people, even many accountants, don't know it exists or how to use it. And if they don't know it exists, they're sure as heck not going to recommend it to you so that you can save tax on up to $10 million of gains. This isn't a deferral. It's not a credit. It is a complete exclusion. The capital gain simply never gets taxed. To qualify for the QSBS treatment, you and the business need to meet 5 specific criteria. So let's get into that and let's break all of those down. Number 1, you have to be a C Corp, not an LLC, not an S Corp. Those kind of companies do not qualify. However, if you are an LLC or an S Corp, you have the ability to convert to a C Corp. So, number 1, you have to have C Corporation status. Number 2, original issuance. You must acquire the stock directly from the company. That can be via cash, it could be via services or property, but it's not buying shares on the secondary market from somebody else. Good example would be the stock market. If you decide a day after the IPO to buy those shares on the stock market exchange, you are not buying those directly from the company, you're buying them from another person. So, number 2 is you have to have original issuance. You must acquire the stock directly from that company. And number 3 is you have to hold for at least 5 years. So, in order for you to qualify for the QSBS exclusion, you have to hold the stock for at least 5 full years before you sell. Number 4 is the assets of the company have to be less than $50 million. And when we're talking about a company's assets, that would include any cash they might have on the balance sheet, any equipment they might own, any IP they may have, and any capital they've raised along the way. So the key is the assets have to be under $50 million when the stock is issued, not sold. And the 5th thing is you have to have an active business requirement. So at least 80% of the company's assets must be used in an active trade or business, and personal services like law firms, accountants, financial advisors, and investment companies, we don't qualify. So if you're a founder, an early employee, or maybe even a seed stage investor, there's a good chance your stock could qualify if it's structured right away from the start. So the question becomes, how much can you actually exclude from capital gains? So if you meet all the requirements, you can exclude the greater of $10 million in capital gains or 10 times your basis in the stock. And just very quickly, on the $10 million in capital gains, what does that actually save you in the form of tax? Well, we have a federal capital gains tax right now of 20%. When your income is high, there's another 3.8% on top of that, the net investment interest tax. So that puts you at 23.8, and then you have whatever your state capital gains tax is on top of that. So it could easily be 25, 30+% of that 10 million. So we're talking $2.5 to $3 million. So example number 1. Let's assume you invest $500,000 in a startup, it grows, and you sell your stock down the road for $6 million. You can exclude the entire gain, the whole $5.5 million of gains from federal capital gains tax. And here's a second example. Let's assume you invest $1 million of your hard-earned cash and you eventually sell your shares for $15 million. You can exclude $10 million of that $14 million gain and pay capital gains only on the remaining $4 million of gains. This is the IRS giving you a tax-free exit if you've done the work and you've actually planned ahead. Now, here's where most people screw this thing up. They build a great business, but they never check the QSBS boxes early on, and you can't retroactively qualify. This has to be planned years before the exit. Remember, we have that 5-year rule. So here's how you set this thing up correctly. First things first, you have to form or convert your company into a C Corp. Remember, we have a 5-year holding period that doesn't start until the qualified stock is issued from the C Corp. The next thing you need to do is you need to issue actual stock certificates or some equivalent documentation. And I would suggest you work with your attorney and or your CPA to document the original issuance clearly and cleanly. Next thing is you need to avoid disqualified business type. So again, that includes banking, law, accounting, health, and financial services practices. And last, you need to watch for state conformity. Not all states are going to honor QSBS at the state level. California doesn't, as an example. New York does. And this affects how much total tax you can actually save. Now, who should actually consider this? Well, QSBS, it's not for everyone, but here's who should be paying attention right now. If you are a founder of a startup or an early stage growth company, you should be paying attention. If you are an investor in a C Corp business that's raising capital, you should be paying attention. If you are in a tech company, a software as a service company, biotech, product, manufacturing business, you should be paying attention. And for anyone planning a future sale, acquisition, or IPO, this might be for you. You should be paying attention. If you're building a sellable company and you're not structuring for QSBS, you could be handing the IRS a check for millions of dollars more than you actually need to. Section 1202 is one of the most generous tax breaks available to business owners, but you have to plan ahead. If you qualify, you could literally sell your business and pay zero in capital gains tax 100% legally and permanently. If this video helped you, hit the subscribe button, like the video. This way you can get more advanced wealth building strategies and tax strategies for business owners. And if you'd like help reviewing your business structure or planning a tax efficient exit, drop a comment below or DM me the word QSBS and I'll reach out. And maybe most importantly, if you want to ensure that you have a successful exit, pick up a copy of my book, Walk Away Wealthy. You can go to walkawaywealthy.com and grab your copy today.